5 Smart Investing Principles. There's no shortage of self-help material available for people looking to boost their investing knowledge. Between television programs, magazines, and other information sources, you can read about the best of this, and the most important that. It can be easy to get confused, especially when you get conflicting ideas. Understanding a few key investment principles can be a great place for you to start. It can give you a better framework to understand the information as you take in the ideas. It can also provide you context for evaluating the concepts and strategies suggested. This video goes through 5 smart investing principles. These are key concepts that could help you understand what it takes to create an investment portfolio that is designed to pursue your investment goals. They're helpful to understand if you want to potentially break the cycle of buying high and selling low. Are there other investing principles? Absolutely. But for the purpose of today's video, we're going to focus on the 5 that we believe are the ones that are critical to understand. Keep in mind that the information in this material is not intended as tax or legal advice. It may not be used for the purpose of avoiding any federal tax penalties. And if you have any questions on this video, please feel free to reach out to us. We have professionals that can help you with that. Let's take a look at our first principle, estimating your time horizon. Generally, if your time horizon is short, you may be more comfortable with more conservative investing approach. Certain investments can be volatile and may not be appropriate if you have a short-term horizon. If your child is headed to college in 5 years, many people would say you have a midterm horizon. You may want to be less conservative with your investing approach and have a larger exposure to equity investments. When you have a long-term horizon, you may consider adopting a more aggressive approach. If you intend to retire in 10 to 15 years, having a larger exposure to stock investments may be more sensible. One way to lower your exposure to stock market risk is by investing for the long term, which gives you money to recover from periods of market fluctuations and loss. Of course, past performance is no guarantee of future results. Let's move from estimating your time frame to our next principle. Know your risk profile. How much tolerance do you have for risk? It's easy to say, I can handle high level of risk, but that may or may not be the case. It is a good idea to ask yourself some pointed questions and be honest with the answers. What happens to my outlook if the value of my investment drops? How much could I lose and stay in the market? It is also helpful to ask yourself, how would I describe my investment knowledge? There are some television programs that help people understand investments and the markets and how they work. But if most of your investment knowledge has come from television personalities, you really may want to consider getting a second opinion on your approach. Here is another helpful series of questions to ask yourself. What would you rather have? $500 right now or a 50% chance at $2,000? Many people go for the $2,000, and rightfully so. Since you have a 50-50 chance, a decision tree shows that a $2,000 answer carries a potential value of $1,000. But let's add a few zeros and see if that changes your perspective. What would you rather have? $50,000 right now or a 50% chance at $200,000? The decision tree says the opportunity to win $200,000 has the highest potential value. But in reality, many people second guess the decision because $50,000 is a lot of money. Remember, there is no correct answer for this question. This example simply helps you better understand the concept of risk. You see, investment risk can be managed, but it can't be eliminated entirely. All investments carry some level of risk, and in general, the greater the risk an investment carries, the higher its potential return. This illustration may help you understand how this all works. Along the horizontal axis is risk. The lowest level is on the left and the highest is on the right. Along the vertical axis is potential return. The lowest is at the bottom and the highest is on top. Different types of investments fall to different places on this graph. Keep in mind, however, that past performance does not guarantee future results. Actual results will vary. With the lowest risk and the lowest potential return are cash alternatives such as certificates of deposit, which are generally considered to be relatively safe investments. If you sell before a CD reaches maturity, you may be subject to penalties. Bank savings accounts and CDs are FDIC insured up to $250,000 per depositor per institution and generally provide a fixed rate of return. Traditional CDs offer a fixed rate of return, whereas both the principal and yield of investment securities will fluctuate with the changes in market conditions. Further up on the graph are debt instruments, such as government bonds. Debt instruments offer slightly higher return, but at slightly higher risk. It is important to remember that bond prices, including on government bonds, rise and fall daily. If a bond is held to maturity, a bondholder will receive the interest payment due plus original principal, barring, of course, default by the issuer. Return of principal is not guaranteed. Next are stock investments, which offer the potential for higher return, but they can also have higher risk. The return and principal value of stock prices will fluctuate as market conditions change, and shares, when sold, may be worth more or less than their original cost. At the top are the speculative tools. Speculative tools are not appropriate for every investor. They carry a high level of risk and, when sold, may have a little or no value. You see, risk can come from different sources. For example, there are external risks that may influence the price of a stock. That is the source of the risk that are outside a company's influence. These may include economic risk, market risk, interest rate risk, political risk, and tax risk. Let's take a closer look at one of those risks, market risk. If the overall stock market trends lower, many stock prices would be expected to trend lower as well. Conversely, if the market trends higher, many stock prices may move higher. It's all like the old expression, a rising tide lifts all boats. On the other side of the scale are company-specific risks. These are risks that are unique to the company, such as delayed product launch, unexpected expenses, supplier problems, and a management shakeup. These are just examples. By buying a stock in an individual company, you're agreeing to accept certain amount of company-specific risk. Next is investment principle.